How self-employment taxes work, and how you can avoid this tax altogether. When most people file their taxes, they are only concerned about one thing: how much money they will owe, or how much money they're getting back as a tax refund. But what they are not typically thinking about are the different types of taxes they are paying, and if there is anything they can do to reduce or not pay that specific tax at all.
Do I pay my taxes? No.
And one of the most significant taxes that most people can reduce is their self-employment tax. But unfortunately, most people fail to reduce this tax because they don't even know they're paying it to begin with, simply because they don't study the details of their own tax return. And others may know they pay this tax but are unaware of the various ways around it. Meanwhile, the IRS just received another $1 trillion last year in employment taxes alone. And guess what? They are not interested in helping you pay them any less. And do you want to know who is absolutely getting crushed by this tax? People who own 1099 or business income. Small business owners pay twice as much employment tax than employees on the same amount of income. And on top of that, they still have to pay their federal and state income tax, amongst several others. But I'm here today to tell you that if you pay this tax, there is something you can do to avoid most of it. And by the way, if you're wondering if you pay this tax, there is a 99% chance that you do if you earn any amount of money that is not taxed before it hits your bank account, which is normally business owners and independent contractors like freelancers, drivers, stylists, and so on. So look, today I'm going to give you the simplest and easiest to understand breakdown of self-employment tax and what you can do to avoid it. My name is Sherman the CPA, and I've saved business owners millions of dollars in taxes by simply conquering their self-employment tax. And today you're going to learn how to do this for free. So be sure to like and save this video and pay close attention here. All right, so let's break this all the way down. What is self-employment tax? Self-employment tax is just a simplified phrase for Medicare and Social Security taxes for business owners, except business owners pay twice as much because they are self-employed. You see, in a normal employer-employee relationship, both the employer and the employee must equally contribute to Medicare and Social Security taxes. Normally, each party contributes 7.65% of the employee's gross income towards these taxes. However, since you are self-employed, you are responsible for paying both the employer's and the employee's portion of this tax, equaling a total of 15.3% of your income. So if you are self-employed, you can kiss 15.3% of your income goodbye. That is until your income exceeds about $160,000 as of 2023. At that point, the tax is then reduced to 2.9% of all of your income that exceeds that amount, which can add up to a very big number for high-income taxpayers. And keep in mind that this does not include your federal and state income taxes, which could add up to another 50% in taxes depending on your state and federal income tax bracket. This is just self-employment tax, a tax that many business owners don't even know that they're paying. So now that you understand what this tax is, let's switch gears and talk about what you can do to avoid self-employment tax. First and foremost, self-employment tax is an income tax, and you have to understand that. Remember, income tax is all based on your income, which means that if you report less self-employment income, you will pay less self-employment tax. Well, how do you do that? There's two primary ways that you can accomplish this. Number one, maximize your tax deductions. Tax deductions reduce the amount of income you pay tax on. Plain and simple. More tax deductions means less income, and less income means less taxes. In this case, lower self-employment taxes. And as a self-employed individual, you are entitled to far more tax deductions and write-offs than W-2 employees. The tax law allows you to literally write off almost any expense as long as the expense is ordinary and necessary for your business. And with proper planning, you can even write off a large portion of your personal expenses to reduce your taxes even more. You can find missing deductions. You can create deductions. You can get a deduction from simply moving money from one bank account to another account. You can even deduct your self-employment tax. There are so many ways you can use deductions to reduce your taxes, and we have videos on all of this, so be sure to subscribe to learn more about it. But the bottom line is that if you want to pay less self-employment tax, the first thing you need to do is make sure that you're maximizing all available tax deductions. And if you do that and find that you still have a lot of income that is subject to self-employment tax, then you can move on to number 2 here. Number 2, change your entity to avoid self-employment tax. So earlier I mentioned that if you want to avoid self-employment tax, you need to report less self-employment income. But what if you didn't report any self-employment income at all? What if you could just change the characterization of your income? Well, you can easily accomplish this by simply changing your business entity. Look, I don't make the rules here, but for some reason, the tax law allows some entities to pay self-employment tax while others don't. Which means that switching your entity to one that does not pay any self-employment tax can single-handedly save you thousands of dollars in self-employment taxes. So let's talk about it, starting with the entities that are subject to self-employment tax. In general, income from pass-through businesses are subject to self-employment tax. This includes most LLCs, partnerships, and unincorporated businesses like sole proprietors. And if you don't know what type of entity you are, 9 times out of 10, you are one of these pass-through businesses because most businesses are. That is, unless you have incorporated some form of corporation. Every business entity pays self-employment tax with the exception of corporations. And there are 2 primary types of corporations: C corporations and S corporations. Again, neither type of corporation pays self-employment tax. However, there are other tax rules and requirements you must comply with depending on the type of entity you select. So let's back up for a second here and talk about how these types of corporations are used in general, and then we'll back into the self-employment tax. So C corporations are generally used by companies who are looking to increase investment capital in their business, whether it is to take on new investors or aggressively reinvest their business profits. Now, C Corps are required to pay corporate taxes on its income, and you'll pay tax again when you pay your shareholders from the C Corp. So if you don't know what you're doing with the C Corp, you could actually end up paying way more taxes and fees than the self-employment tax. So you have to know what you're doing here. And because of this, C corporations are not typically recommended for most small business owners. So then let's talk about the most favored entity amongst savvy small business owners: S corporations, also known as the Small Business Corporation. An S corporation is a specific tax election you can make with the IRS as either an LLC or a C corporation. So if you already have an LLC, all you would have to do is file a form with the IRS to let them know that you wish to be an LLC taxed as an S corporation. Now remember, S corporations do not pay any self-employment tax at all, technically. And that is because S Corp income is not considered self-employment income. Even better, S corporations are not subject to corporate income tax like C corporations. So the money you earn in your S Corp will flow through to your personal tax return just like it would with a pass-through business. It's really that simple. I promise you this is not some tax trick or loophole. This is literally written in the tax law to favor small business owners. However, with any entity, there are rules and regulations you must comply with. So listen up here. As an S corporation, the most notable requirement is the one that states that shareholder employees must pay themselves a reasonable salary for the work they do in the S corporation. And this salary must be ran through a payroll system, which will also be subject to payroll taxes. And by the way, those payroll taxes will include Social Security and Medicare tax, which is what the entire self-employment tax was meant to fund to begin with. So basically, this is how the IRS manages to still collect some level of employment tax, Although S corporations do not technically pay any self-employment tax, you will still pay some Social Security and Medicare tax out of the wages you take from your business. But don't let this discourage you, because electing S Corp status will typically still save you way more money in Medicare and Social Security taxes than not electing it. And here's why. Without an S Corp, you pay self-employment tax on 100% of your business income. But with an S Corp, you can pay self-employment tax on as little as 30 to 50% of your business income. And this is done by taking a salary from your S corporation that is much less than your business income. And most CPAs believe that a reasonable salary for an owner that works in an S Corp is generally about 30 to 50% of your business income. Now keep in mind that this is just a general rule. You also have to keep in mind the type of work you're doing, the amount of hours you're working, and the market rate for comparable services that you are providing to the S corporation. And once you set the salary, you also need to set up a payroll system through a platform like ADP, Gusto, and QuickBooks to pay yourself. And I have videos right now on this channel that will walk you through everything that I just mentioned, from how to form your S Corp to how to run payroll as an S Corp. So be sure to subscribe and watch those videos next. And if you need immediate assistance, like right now, to reduce your next tax bill, apply to become a client today at mycpacoach.com. Thank you for watching.